Every day we listen to reports on various news platforms about this or what with regard to cryptocurrencies, and with the recent market correction, the market has been in a state of confusion. But that's exactly an issue. Everyone seems to be pointing out the problem, but no one actually seems to be keen on providing solutions. And those that care enough to guide others do so at a fee in the form of online courses, paid seminars, and more. This is why I saw the need to put up this video and provide some useful tips to guide you trading in a time when the market seems to be bullish. These tips are more safety rules, and as the soldiers would have it, such as those are written in the blood. Even though we're not talking about risking human lives here, losing your coins due to trading without a proper guideline isn't a fun moment. So, how can we avoid making costly mistakes? How can we ensure that we always remain on the green side? First of all, you need to understand that profitable trading requires a lot of effectiveness. It's not a gamble, and nor should it be one. Other than the following 10 tips, ensure that you pay close attention to the market forces of demand and supply to be able to know when this or that tip applies. It's paramount to internalize every tip in this guide and to understand the reasoning behind it. With that, let's begin. Here are the 10 tips for cryptocurrency trading. Have a motive for entering each trade. Now, I know this might sound obvious, but it's important for you to have a clear purpose for getting into cryptocurrency trade. Whether your purpose is a day trade or to scalp, you need to have a purpose for starting to trade cryptos. Trading digital currencies is a zero-sum game. You need to realize that for every win, there is corresponding loss. Some wins, some loses. The cryptocurrency market is controlled by a rage whales, pretty much like the one that plays thousands of bitcoins in the market order box. And can you guess what these whales do best? They have passions. They wait for innocent traders like you and me to take a single mistake that rents our money to their hands due to their avoidable mistakes. Whether you're a day trader or scalper, sometimes you are better off not gaining anything on a certain trade than rushing your way into losses. From our years of market analysis, we can comfortably tell that on a certain day or period, you can only stay profitable by keeping off some trades. Set profit targets and make sure use of stop losses. If you've not heard the term stop loss in trading, here is where you'll understand. Every trade we get into requires us to know when to get out, whether we are making a Bitcoin profit or not. Establishing a clear stop loss level can help you cut your losses. It's clear that every has in most traders. Choosing a stop loss is not a random activity, and perhaps the most important thing to note here is that you shouldn't be carried away by your emotions. A great point to set up your stop loss is at cost of your coin. If, for instance, you acquired a coin at $1,000, set the minimum point you are willing to trade your coin. This ensures that if the worst comes to pass, you can walk away with what you invested in the first place. The same applies to profit levels. If you are targeted to get out of the market after hitting a certain minimum profit, stick to that. Don't be greedy. It's never nice around anyone. Welcome to FOMO. FOMO is an abbreviation of a fear of missing out. This is the most notorious reason as to why many traders fail in the art. From an outside point of view, it's a new good scene seeing people to make massive profits within a minute from pumped coins. Honestly, I never like such a situation any more than you do. But I will tell you one thing that's for sure. Beware of that moment when the green candles seems to be screaming at you and telling you to jump in. It's at this point where the whales I mentioned earlier will be smiling and watching you buy the coins they bought earlier at a very low price. Guess what normally follows? These coins usually end up in the hands of small traders, and the next thing that happens is for the red candles to start popping up due to an oversupply, and voila, losses start trickling in. Manage your risks. Little pigs eat a lot, but big ones get eaten. This is especially true of market profits when trading cryptocurrencies. Wise traders never run in the direction of massive profits. Nope, they don't. They would rather stay put and gather small but sure profits. Consider investing less of your portfolio in a market that is less liquid. Such high trades require more tolerance, while the stop loss and profit target point will be allocated further from buying level. Underlying assets create volatile market conditions. The price of most altcoins depends on the current market price of Bitcoin. It's vital to understand that Bitcoin is relative to fiat currencies and is quite volatile. The simple version of this is that when the value of Bitcoin goes up, the value of altcoins goes down and vice versa. The market is normally forged when the Bitcoin price is volatile, and as you would imagine, this prevents most traders from gaining a clear understanding of what goes on in the market. At this point, it is advisable to either have a close targets for our trades or simply not trade at all. Don't buy simply because the price is low. Most beginners make one of the common mistakes, buying a coin when its price seems to be low or what they consider affordable. Take, for example, someone who goes for a repo instead of Ethereum simply because the latter is much cheaper. The decision to invest in a coin should be very little to do with its affordability, but a lot to do with the market capital. Just like conventional stocks are gauged by their market capitals, which is evaluated by using a formula: current market price times total number of outstanding shares. The same applies to cryptocurrencies. There is no difference between having a coin priced at $10 per coin with the total number of 1 million shares in the market, and the same coin being priced at $100 with 100,000 shares in the market. For this reason, it's more justifiable to use coin's market capitals to decide whether or not to invest in it than using its price. The higher the coin market capital, the more suitable for it to invest. A tip about crowd sales or ICOs. During an ICO, initial coin offering, startups offer the general public an early chance to invest in their ideas through the crowded sales. In return, these investors allocated tokens at lower price with a promise to sell them at a much higher price when listed on an exchange. Time has proven that ICOs can quite successfully with records showing that some tokens ended up more than 10 times the value of the project returns. But what's the catch in this, you might ask? ICOs have attracted a large number of investors clearly due to their high returns. However, another large number of ICOs have turned out to be a total scams. People have lost millions worth of investments. There is a need of one to be more than conscious when looking to invest in any ICO. Knowing when to or not to invest in an ICO is not about science rather, but it's about paying close attention to those details that most people seem to overlook while only focuses on promises returns. Conduct a background check on the team behind the project and analyze their ability to deliver on their promises. In addition, you should also look at the viability of the idea behind the ICO, poke holes in the project's white paper, and seek answers where necessary. That will ensure that no stone is left unturned, and if by the end of it you still have a doubt about the project, you are better off passing than chance it investing in that ICO. A quick one of altcoin investors. A lot of altcoins end up losing value over a certain period of time. Sometimes it's an unusual short period of time. It's therefore paramount to understand that whenever you hold an altcoin for a long time, be careful not to hold them for too long. One of the best measures of coins that are perfect for long-term investment is the daily trading volumes. The higher the daily trading volumes, the more suitable an asset for long-term investment. If you're looking on going long-term with the cryptocurrencies, consider investing in some of the following coins: Ethereum, Factor, Monero, and Dash. These have decent trading volume on various exchanges around the world. Be sure to also observe the chart of these coins and take note of the various price spikes. The pattern can help you to know the periods to sell or buy a coin. Diversify, and diversify. Investments are unpredictable. Even those that seems to offer infinity positive returns can come crumbling down under the certain economic conditions. Cryptocurrencies are even more unpredictable. As much as you can reap profits in thousands in a day or less, the opposite is also true. You can lose everything you invest in digital assets in a flash of a second. So, the best way to get past such as the uncertainties is through diversification. Like I mentioned earlier, the value of all coins is affected by the value of Bitcoin against the US dollar. When Bitcoin loses the value against the dollar, all the other coins lose the value and vice versa. From that, you can clearly see that diversifying your portfolio among various coins may not be enough to caution you against bullish markets. Do you remember when Bitcoin was all-time high in late 2017 year 2018? Everyone knew the way to go was just just to buy many digital currencies as possible to gain more value over the dollar. But having volatile base assets like Bitcoin comes when it's challenging. As you may have noticed, in the second half of 2018, Bitcoin made a lot of people rich in the shortest time than in the history of any known investment. The truth is, billionaires were made, and what most people never seems to understand is that a lot of people also lost money. And in the midst of all this, the currency managed to grow its market capital by over 30 times more in the past year alone. This means that it's okay for traders to keep Bitcoins as their base assets, but they also need to realize the value of dollars cannot be overlooked. You need to diversify away from the same types of assets to different areas so as to spread your risk. There are other equally viable investments that are not as risky as compared to cryptos. These are real estate, mutual funds, stocks, and more. Super tip. The final tip will offer you practical steps to start implementing immediately in your trading. Make use of the goal setting features by pressing sell orders. Make sure that you set your revenue targets by pressing sell orders in the order box. You never know when your order price will be met, meaning you exactly what you need. Besides, sell orders attracts fewer transaction fees since they are market markers. Take it easy when trading. They say the best traders mastered the art of maintaining their cool even when things seems to be out of hand. Yup, I know how insane that sounds, but you've got to develop the skills of not trading emotionally, but objectively.